The rise of new energy vehicles is unstoppable, and gas stations are now facing waves of closures. This is Huanan Expressway, Guangzhou's busiest urban expressway, connecting Tianhe, Haize, Panyu, and Baiyun. It's always packed with traffic. I often pass by here when swapping my EV battery, but today I suddenly noticed that this gas station has also shut down. It makes sense when you think about it. Guangzhou's new energy vehicle penetration rate has exceeded 50%. Whether it's hybrid, range extended, or fully electric, cars in urban settings are now running entirely on electricity, making gas stations increasingly unprofitable. As a result, many are shutting down. In the future, range extended and hybrid vehicles may even struggle to find gas stations when needed.
In just a few years, new energy vehicles have surged in China, while demand for traditional fuel-powered cars has weakened. Coupled with persistently low international oil prices, China's once dominant oil giants PetroChina, Sinopec, and CNOOC have been significantly impacted. Refineries across the country have had to shut down in batches. Gas stations are closing one after another, and many fuel pumps sit idle. Quarterly financial reports show a steep decline, with Sinopec's Q3 net profit slashed by half. PetroChina's revenue down 12%, and CNOOC's third quarter revenue falling below 100 billion yuan. The petrochemical empire has taken a severe hit. The rise of new energy vehicles has led to a decline in both the sales and prices of gasoline and diesel. In 2024, gasoline consumption reached 177 million tons, down 2,800 tons from 2023. At the beginning of 2024, 92-octane gasoline sold for 85,000 yuan per ton, but by year's end, the price had dropped to 7,900 yuan per ton. This downturn has hit gas stations hard. A typical Sinopec gas station has daily fixed cost of 86,000 yuan, including rent, labor, and equipment depreciation. At a gasoline price of 8,842 yuan per ton, the station needs to sell 21 tons of fuel daily, generating 185,700 yuan in revenue, just to break even. To meet this target, the station would need to service 47 large SUVs like Mercedes GLS in the first 9 hours of operation. However, most stations don't see their 20th customer until the afternoon. By 2024, 25% of gas stations, more than 6,800 locations, were selling less than 21 tons of fuel daily. This forced Sinopec to shut down 2,300 stations, which reduced annual convenience store revenue by 42,000 yuan per station, costing the company 3.4 billion yuan overall. Unlike gas stations, electric vehicles charging stations require only 19% of the workforce, leading to 17,000 employees facing layoffs. Compensation agreement for these layoffs could total 2.2 billion yuan, or 9% of Sinopec's annual profits. Training these workers for other roles presents another challenge, as 41% are over 45 years old, adding significant cost and difficulties. Sinopec plans to close 12,000 gas stations, 38% of its total, between 2024 and 2026 during this transition period. Across the industry, the total number of gas stations is expected to drop by 20%. The industry had years of warning. Between 2016 and 2018, Tesla approached PetroChina with a proposal to build charging stations together. Tesla offered PetroChina a 27% stake in the joint venture if it all allocated 20% of its gas station space for chargers. PetroChina's management dismissed the idea, scoffing at the potential of electric vehicles, saying if EVs manage to capture 5% of the market, that'd already be impressive. Why would we, a national oil company, give up our golden assets to Tesla? Absurd. Now, retrofitting a gas station into a charging station costs 3.2 million yuan. Many sites have limited grid capacity, only allowing 4 charging stalls. Operators must also offer customers a discount of 0.17 yuan per watt-hour to attract business. The partnership they once rejected has become an unattainable dream. The diesel market has been hit even harder. Diesel consumption dropped 5.4% in 2024, a decrease of nearly 10 million tons. Prices fell from 7,200 yuan per ton at the beginning of the year to under 7,000 yuan by year's end. The decline is largely due to the popularity of electric heavy trucks and LNG-powered trucks, which offer much lower operating costs. An electric heavy truck can save 160,000 yuan annually, while an LNG truck saves 200,000 yuan. Stricter national VI emission standards have also led to 40% of older diesel trucks retiring early. Additionally, reduced infrastructure projects and fewer operating hours for construction equipment have further dampened diesel demand. In 2024, profits in the refining sector plummeted by over 90% year-on-year. The average gross profit per ton of oil dropped from 661 yuan to less than 50 yuan. Refining 1 ton of crude oil into fuel now results in a loss of 200 yuan. This situation has forced 25% of major refineries to suspend production. Experts warn that if these trends continue into 2025, the industry could face 380 billion yuan in stranded assets, equivalent to the total investment in 3 Hong Kong-Zhuhai-Macau bridges. This could also directly cut 6% from PetroChina and Sinopec's revenues. Producing crude from sources like Shandong's Shenli oil field or Venezuela exacerbates the issue, with losses reaching 245 yuan per ton while refining it into diesel or gasoline. Shandong's independent refiners saw profit drop by 70% year-on-year, with capacity utilization hitting a historic low of 50%. Many of these refineries have relocated to Xinjiang, where factories display signs reading "relocated" or "for auction." When refineries halt production, the impact extends far beyond the companies themselves. Industries reliant on equipment maintenance, pipeline upgrades, and catalytic cracking repairs also suffer due to a lack of business. For instance, Qingdao Refining, with an annual catalytic cracking capacity of 2.9 million tons, was forced to shut down due to market sluggishness. As a result, the equipment maintenance sector market size plunged from 21.7 billion yuan in 2023 to 8.9 billion yuan in 2024. Many small and medium-sized maintenance companies faced cash flow disruptions, with 73% unable to see hope for the coming year. The situation worsened with a sharp drop in demand for the molybdenum nickel alloy steel, falling from 120,000 tons per month to just 38,000 tons. This caused steel giant Baogang's group revenue to shrink by 68%. Baogang now faces 4.7 billion yuan in maturing debts, and its shrinking specialty steel business has left its cash flow insufficient to cover interest payments. The company's default risk stands at 79%. If Baogang ceases production, the supply chain for wind and nuclear energy equipment will also be disrupted, potentially hindering China's energy transition plans. The shutdown of refineries has already triggered a ripple effects across industries, impacting various sectors of the economy. If diesel demand continues to decline, production will also drop, causing 23% of the nation's hazardous goods transport fleet to halt operations due to a lack of fuel. This could be devastating for spring farming, as 63% of China's fertilizer transportation relies on diesel trucks. A halt in diesel truck operations could cut daily fertilizing deliveries by 147,000 tons. In the North China Plains, 5.6 million tons of fertilizer need to be delivered by March 15th, but supply is already 890,000 tons short. The Heilongjiang Beidahuang Agriculture Reclamation Group has even activated a diesel quota emergency mechanism to cope. However, LNG trucks cannot fully replace diesel trucks, despite a market penetration rate of 13.6% nationwide, LNG fueling stations coverage is only 38%, leaving many areas without access. Compounding the issue, transporting fertilizer from factories to fields requires 7 stages of diesel truck transfers. Delays beyond 56 hours could miss the critical planting window, significantly reducing crop yields. During China's 13th five-year plan, the petrochemical industry experienced rapid growth, with massive investment focused on increasing output and expanding capacity. This led to record-breaking production capabilities for basic and general-use materials. Even though China's crude oil processing volume fell 3.6% year-on-year in 2024, capacity continued to expand uncontrollably, reaching 961 million tons annually. Another 70 million tons of capacity is expected to come online by 2025. In 2024, China imported 553 million tons of crude oil, a 1.9% decrease from the previous year. However, port storage tanks were nearly full. The storage tank utilization rate at Qingdao Port surged to 93%, with tankers waiting cut off the coast stretching to the China-Korea maritime boundary in the Yellow Sea. Meanwhile, 1 million tons of crude oil equivalent to North Korea's annual consumption accumulated in the Bohai Bay area. This oil congestion appears to be due to low refinery operations, but it is closely tied to China's Ministry of Commerce crude oil import quota system. In 2024, the ministry issued a full-year import quota of 243 million tons and added more allocations. However, the rigid rules of the quota system penalize refineries by significantly reducing next year's quotas if they fail to use this year's allocation. As a result, local refineries are forced to prioritize purchasing and stockpiling crude oil even if they cannot process it, to secure their future quotas. This practice drives refineries to take on high-interest short-term loans, leading to heavy debt burdens. By 2024, the average debt-to-asset ratio for Shandong independent refineries exceeded 70%. Leading independent refiners such as Zhejiang Petrochemical and Hengli Petrochemical have begun transitioning to producing high-value-added chemical products like photovoltaic-grade EVA and biodegradable plastics. However, most small and medium-sized refineries lack the technical capabilities of such a shift. Many are barely hanging on, waiting to be phased out. By the end of 2024, the number of Shandong independent refiners had dropped to 28, a sharp decline from the peak of 53 in 2018. Before leaving office, Biden dealt a heavy blow to Russian oil with a series of sanctions targeting exporters and tankers. Within days, Russia's daily oil exports were slashed by 1.5 million barrels, pushing global oil prices to a 5-month high. Just as these sanctions began taking effect, the U.S. announced plans to replenish its strategic petroleum reserves with a purchase of 300 million barrels. This move sent global oil prices soaring with no immediate relief in sight. However, newly inaugurated President Trump broke from convention, announcing his intention to push oil prices below $50 per barrel by mid-year and keep them at that level for the long term. For China, lower oil prices might seem like a win, as importing cheaper oil from Iran and Russia avoids sanction risk, but the reality is more complex. The key issue isn't price, it's access. Under Biden, China could purchase Russian oil using the yuan. Under Trump's tighter sanctions, 60% of Russian oil is now off limits. This forces China to turn to Saudi Arabia and the UAE, where transactions are conducted in US dollars. This shift is a setback for the internationalization of the yuan. If the yuan depreciates further, the financial losses will compound. In China, domestically low oil prices appear beneficial on the surface but create challenges for refineries. While crude prices drop, refined fuel prices follow, leaving profit margins unchanged. Weak domestic demand for gasoline and diesel exacerbates the problem, making it harder for refineries to sell their products. Upstream Oil Extraction faces even greater struggles. At 50% per barrel, PetroChina and CNOOC are under immense pressure. PetroChina's extraction cost hover near $50 per barrel, leaving virtually no profit. CNOOC fares slightly better, with costs under $30 per barrel, but its profitability is significantly reduced compared to $80 per barrel. Combined with increasing competition from the renewable energy sector, the days of easy profit from oil extractions are long gone. For PetroChina and CNOOC, if refining becomes less central to their business and crude oil sales take precedence, low oil prices could become a serious threat to their survival. This shift clearly signals that the road ahead for China's oil giants will not be easy. On the international front, Wall Street's financial powerhouses are seizing the opportunity to exploit China's oil sector. Hedge funds like Goldman Sachs are capitalizing on the price gap between Shanghai crude oil and West Texas Intermediate crude. When the SC WTI price gap reaches $7.4 per barrel, Goldman Sachs cannot directly trade in the SC market. However, they leverage Middle Eastern crude oil trades in Singapore to indirectly influence SC prices. By depressing SC prices and simultaneously increasing WTI positions on the New York Mercantile Exchange, they execute a dual arbitrage strategy. Data shows that for every $1 increase in the SC WTI price gap, hedge funds and their collaborators extract approximately 240 million yuan daily from China's market. After deducting transaction costs and sharing profits, Goldman Sachs could still achieve a daily net profit of up to 150 million yuan, depending on their scale and success rate. This strategy places significant pressure on China's petrochemical industry. Lower SC prices reduce revenue from crude and refined oil sales, while higher WTI prices increase the cost of imported crude oil. This combination narrows profit margins for Chinese refiners, pushing some to the brink of bankruptcy. China's refineries operate at an average utilization rate of 75.5% compared to 90% in the US weak domestic demand market. SC prices more vulnerable to declines. Meanwhile, the US leverage AI-driven drilling technologies to achieve the lowest extraction cost globally, keeping WTI prices relatively stable. In contrast, China's technological limitations and high extraction costs make it difficult to establish a competitive pricing average. Goldman Sachs has also capitalized on the depreciation of the yuan, which raises China's crude oil settlement cost, further driving down SC crude prices. Meanwhile, escalating tensions in the Middle East have increased global oil price volatility, providing even more opportunities for arbitrage. In recent years, Beijing has poured resources in its ambition to replace petrochemical energy with new energy sources, aiming to reduce reliance on foreign oil. The 2025 energy law serves as a catalyst for this plan, prioritizing non-fossil energy and accelerating industries like electric vehicles, solar power, and energy storage. With financial subsidies fueling the momentum, the new energy sector is thriving. Once the production of cost of electric heavy trucks and hydrogen-powered vehicles decrease, the shift to new energy for heavy-duty vehicles will be unstoppable. But can new energy sustain the system? While the energy law paints a grand vision, implementation reveals several challenges. Can the power supply chain handle the large-scale demand of new energy? Will dependency on rare materials like lithium and cobalt replace reliance on oil? With international competition in new energy intensifying, will geopolitical tensions escalate further? The plight of China's three oil giants, PetroChina, Sinopec, and CNOOC, must also be addressed. While Beijing touts its strategic transition, it shows little favor towards these state-owned oil companies. Domestic fuel prices hover around 8 yuan per litre, with 4 yuan going to taxes, 2.8 yuan covering crude oil cost, and leaving Sinopec with just 1.2 yuan in profit. In comparison, ExxonMobil in the US operates with fuel prices of 3 yuan per litre with only 15% tax, allowing for an 0.8 yuan profit per litre. If ExxonMobil operated in China with 8 yuan fuel prices, it would make 2.1 yuan per litre, nearly double Sinopec's margin. This stark contrast highlights the struggles faced by China's oil giants. The underlying reasons are straightforward. Beijing recognizes that China's domestic oil reserves are scarce. If prices are too low, consumption will skyrocket, posing a risk in times of war or crisis. However, excessively high prices burden society and alienates consumers. To balance these pressures, Beijing tightly controls tax revenues, leaving little room for the oil companies to profit. Yet, as new energy vehicles continue to gain market share, the challenges for PetroChina, Sinopec, and CNOOC grow even more severe. The developments in 2024 are just the beginning of this transition. The greater and more complex impacts lie ahead. Beijing hopes for the rapid rise of new energy while avoiding the fallout of mass unemployment and economic downturn. But achieving a perfect balance is unrealistic. Once this transition affects critical sectors like industry, energy, and agriculture, unexpected challenges will likely emerge, compounding existing problems. At this juncture, it's worth pausing to ask, when refineries turn into industrial ruins and rusty gas stations fade into history, who will fill the void they leave behind? Who stands to profit immensely from this shift? Most importantly, who will bear the irreplaceable cost of the disruption and transition? One thing is certain, the golden era of China's petrochemical industry is over. The day of long queues at gas stations and soaring profits on financial reports are gone for good.